Hey everyone, and welcome. Today, we're going to cut right through all the complicated jargon and give you a super simple 5-step plan to find fantastic, high quality dividend stocks. We're talking about building a portfolio that actually pays you year after year. Okay, let's get right into it. So, let me just ask you, are you ready to build a portfolio that pays you to own it? I mean, that's the real magic of dividend investing, right? You're creating this stream of income from companies you actually believe in. And today, we're going to throw the map to get you there. All right, first things first. We have to understand something that is absolutely crucial. Not all dividend stocks are the same, not even close. We're not just looking for any company that happens to pay a dividend. No, we are on the hunt for high-quality ones. This is all about building a real wealth machine for the long run, not just chasing a quick payout. Now have a look at this, because this comparison really says it all. Over on one side, you've got these risky, high-yield stocks. They look tempting because the payout seems huge, but that's often because their stock price is tanked, which is a sign of weak financials. It's what we call a yield trap, and it means that dividend could get slashed at any moment. But then you look at the other side. High-quality dividend stocks. These are the foundation of a solid portfolio. We're talking consistent payments, strong financial health, and a history of growing that dividend. We are laser-focused on the right side of this slide, building that wealth machine. So you're probably asking, okay, that sounds great, but where do I even begin to find these companies? Perfect question. Let's move to our very first step, which is all about creating a smart and simple starting point for your research. This is going to save you a ton of time. Your first stop should be lists that basically pre-screen for quality. And a fantastic example of this is the Dividend Aristocrats. These are the big, stable, blue-chip companies that have not only paid, but have increased their dividends for over 25 years in a row. We're talking giants you've heard of, like Coca-Cola or Johnson & Johnson. That kind of consistency is just incredible. And hey, this isn't just a US thing. Many big stock markets all over the world have their own lists of these dividend champions. Now, another brilliant starting point is something called a dividend ETF, which stands for Exchange Traded Fund. So instead of buying just one company, an ETF lets you buy a tiny piece of a huge basket of dividend-paying stocks, all in one go. The huge advantage here, instant diversification. You're not putting all your eggs in one basket. You're spreading your risk across dozens, sometimes even hundreds of quality companies. It's a really smart way to start. Okay, so once you've found a few potential companies from those lists, it's time for step 2. We're going to do a quick financial health check. Think of it like popping the hood on a car before you buy it. And don't worry, you absolutely do not need to be an accountant for this. We're just looking at a few key numbers to see if the company's in good shape. We're going to check just 3 things. First, the payout ratio. Basically, can the company actually afford the dividend it's paying? Super important. Second, we'll look for growth. Are their sales and profits actually going up? A company that isn't growing is, well, stagnating. And third, we'll take a peek at its debt. We want to make sure it's not buried in it. This is so critical because legally, a company has to pay its debts before it pays its shareholders. So if there's too much debt, your dividend is the first thing on the chopping block in tough times. Let's really zero in on that first one, the payout ratio. This number just tells you what percentage of a company's profit is being paid out to shareholders as dividends. What you want to see is a ratio below 70%. So why that number? Well, because it means the company has a nice, healthy cushion. It's keeping enough of its profits to reinvest back into the business to create future growth, and it gives them a buffer to protect that dividend if profits take a temporary hit. All right, let's keep building on this. Now that we know the company is financially healthy, we need to look at the dividend itself. Is it safe? Is it growing? And maybe most importantly, are we paying a fair price for it? This is going to cover steps 3 and 4 of our process. This slide right here shows you exactly what you're looking for and what you need to run away from. On the left, you see that beautiful, steady stair-step pattern. That's what we want. It represents reliable dividend growth year after year. It screams healthy, growing company. But the chart on the right, that's a major red flag. That sharp drop is a dividend cut. It's often a signal that the company is in real financial trouble, and it's a huge warning sign for investors. We are always looking for the chart on the left. So to wrap this part up, always check that dividend history for any of those scary cuts we just saw. Ideally, we're looking for a nice, consistent growth rate, somewhere in that 5 to 10% range per year. But a great dividend isn't enough. We also have to think about the price we're paying. A quick way to do this is to look at the price to earnings, or PE ratio. It helps you see if a stock is cheap or expensive. How does it stack up against its own history or its competitors? And remember what we said at the beginning. Be really careful of those unusually high yields. They're usually a trap. I really want you to let this one sink in. Even the best dividend stock can be a bad investment if you overpay. This is the heart of step 4. You see, finding an amazing company is only half the battle. Buying it at a reasonable price is what turns a great company into a great investment. All right, we have covered a lot of ground. So now let's pull it all together into one simple, clear action plan. This is step 5, and it's also a recap of our entire process, turning all these ideas into a practical strategy you can actually use. The 5th and final step is all about how you actually build your portfolio, and the key principle here is diversification. You just don't want to put all your money into 1 or 2 stocks, no matter how amazing they seem. By spreading your investment across, say, 5 to 10 quality companies in totally different industries, you protect yourself. If one company or one whole sector has a bad year, it doesn't sink your ship. Simplicity and diversification, they are your best friends in investing. So here it is, your 5-step plan, all laid out. Step 1, start your search with those high-quality lists, like the Dividend Aristocrats, or with broad ETFs. Step 2, do that quick financial health check, payout ratio, growth, and debt. Step 3, dig into the dividend itself. Is it stable? Does it have a strong history of growth? Step 4, always consider the valuation. Don't overpay. And finally, step 5, take the great stocks you found and build yourself a diversified portfolio of about 5 to 10 solid names from different industries. And that's it. A straightforward framework that anyone, and I mean anyone, can use to start building a reliable dividend portfolio. If you found this guide helpful, it would be awesome if you could take a second to hit that like button, maybe share it with a friend who'd find it useful, and of course, subscribe for more explainers just like this one. Now, before you go, I have a question for you. Using this exact framework we just walked through, what's the very first quality stock you're going to research? Drop your answer down in the comments below. I'd seriously love to see what you find. Thanks so much for watching, and I'll see you in the next one.